Hey, how's it going, everybody? Welcome to Finance with Avron. In this video, I want to give you a summary explanation breakdown of the one big beautiful bill and how it could affect your money. Now, this is a huge bill. It's like 900 pages, but I'm going to try to condense it in here. This is going to be totally not political at all. I'm not saying in favor of the bill, against the bill, anything like that. This is not an opinion of the bill at all. This is strictly from a personal finance perspective. Let's get right into it here. First, starting with the income tax rates and standard deduction. What has changed? Now, the Trump era tax brackets from the 2017 Tax Cuts and Jobs Act were set to expire after 2025. A lot of that was extended. This bill makes those tax cuts permanent for individuals and families. Of course, Trump back in office, he's going to want to extend what he did at his previous term as president. Now, the standard deduction increases are for 2025 and forward. For those filing single, it increased from $15,750 to $16,750. For married filing jointly, it increased from $31,500 to $33,500. Head of household adjusted similarly, and also this is inflation adjusted annually. This is something you're going to find as a theme throughout this with the big beautiful bill. There are some areas that are going to be adjusted for inflation annually. So that is interesting right there because that would have been nice the past few years with the inflation and how crazy it's going. Who knows what's going to happen later on in the next couple of years? Inflation could go back up like crazy. So now, benefit of this situation right here with the income tax rates and standard deduction is that it could keep taxes lower for most households. Bigger deductions mean lower taxable income. And I'm going to talk about that a little bit more in another section as well. Now, these changes apply through 2028 unless extended further. Now, let's get on to the next section here, and that is going to be the child tax credit. What has changed with this one? Well, it has raised from $2,000 to $2,200 per child. And this is now indexed to inflation as well, so it could rise over time. Now, rules and eligibility for this one. The child must have a valid Social Security number, and at least one parent must also have a valid Social Security number. Now, the phase-out ranges remain the same for this: $200,000 for those filing single, $400,000 for those married filing jointly. Benefits of this one, of course, could help families offset certain costs with children, and also value with this growing over time due to inflation. People don't see their income go up to match inflation often, so having something to match inflation is a good thing, I would think, for sure. Now, like I said, with this bill, there's some things that people are definitely not going to like that you probably heard already, things you may not like for sure. There's some things that's going to maybe help you in this bill, and there's some things that could probably hurt you, in this bill. So let's go on to the next section that's going to affect seniors. So seniors are going to get a tax boost with this bill. New senior bonus deductions from 2025 through 2028. This adds $6,000 in deductions for single taxpayers aged 65 and up, and it adds $12,000 deduction for those married couples 65 and up. And now that's on top of the standard deduction. So there's an increase right there of deductions for seniors. It's going to start phasing out at $75,000 for those that are single and $150,000 for those married filing jointly. And that phase out reduces $1 for every $1 over the threshold. Benefits of this one: this could be significant savings for seniors with moderate income and could also reduce that taxable income by tens of thousands of dollars if both spouses qualify. Could things be cut further? Could there be more help to the middle class and lower class? There's always that, of course, when you got these kind of bills with credits. Let's get on to the next slide here, and that is going to be deduction for workers, tips, and overtime. There is some overtime. This is one thing that Trump was running on during his campaign, saying he's going to get rid of taxes on tips, overtime, things like that. Kind of did this with this bill. Of course, there's some limits and things. Let's get into it here. New deductions introduced: up to $25,000 in tip income is now deductible. And there's also overtime pay deduction, up to $12,500 for those filing single and up to $25,000 for those filing jointly. How this works now: you're still going to report your full income, including the tips and overtime, on your taxes, but you'll be able to deduct the amounts on your tax return. Now, this could lower your adjusted gross income, the AGI. There's income phase outs though, of course, with this. The phase out starts at $75,000 for those that are single and $150,000 for those filing jointly. And then there will be, for every $1 over the limit, you'll lose $1 of the deduction, similar to the senior deduction that was on that previous slide there that I made. Now, example of this right here, because this could be kind of, you're thinking like, okay, what do I deduct? What's the taxes on this? Let me give you an example of this. A single earner with $80,000 in AGI, adjusted gross income. So let's say that's $5,000 over the limit right there. Their limit is $75,000 for the phase out. So they're going to lose $5,000 of the deduction. Now, if they had $10,000 in overtime pay and $5,000 in tips, so $15,000 total in this situation of extra money from overtime and tips, they could only deduct $10,000 because they are $5,000 over the income phase out level. So let's say their adjusted gross income for the year was $65,000 as a single earner, and they had $10,000 in overtime pay and $5,000 in tips. Well, they'll be able to deduct that full $15,000 from their adjusted gross income, which would reduce that $65,000. So that is how that works right there with the deduction of overtime and tips. Now, of course, it doesn't have to be both. You don't have to have both to qualify for this. You could just have overtime, or you could just have tips. If your tip situation is something that doesn't keep track of itself through your employer of some sort, you may want to start keeping an organized, spreadsheet or something of your tips, so you'll know when it comes to doing your taxes. Overtime is typically organized for you on your paycheck, where you'll be able to see, I worked that much overtime that year. So, you'll have that. I think there was one year I did something crazy. It was like hundreds of hours of overtime. There was a couple years I was really working a lot of overtime. And so this would have been nice then, but I do have some overtime this year for sure. Like this week, even at work, I believe I've done 20 something hours of overtime, I believe. So overtime deduction is nice right there. Benefits of this one, of course, is a direct tax breaks for hourly and service workers. And this could possibly move you into a lower tax bracket. You see in that example where I stated the earner had $65,000 in adjusted gross income, but then let's say they had $15,000 in overtime. Well, that brings them down from $65,000 to $50,000. Depending on your income in the tax brackets, this could possibly move you into a lower tax bracket. All right, let's move on to the next section here. That's going to be car loan interest deduction. This was an interesting one. What's new with this? So you can deduct up to $10,000 a year in interest on loans for United States made vehicles. Now, this is available through 2028 as of now. So keep that in mind, because it's not for the life of the loan. If you got a 10-year loan on a car, you're not going to be able to deduct that interest for that full 10 years, just through 2028 as of now, unless this gets extended. For eligibility, the vehicle must be purchased new after the bill's passage. Now, this bill is pretty much, they're getting past the revised edition. It passed the House, it passed the Senate. As of now, it's just waiting on the president's signature, which pretty sure he's going to sign it. And now also, the vehicle must be manufactured in the United States. That's that push again for buying vehicles in the United States. That's why I see a little crossover slightly with the EV tax credit, because that was really trying to increase, buying of U.S. vehicles, even though there's a little stipulations here because the U.S. doesn't have the ability right now to completely manufacture a complete electronic vehicle without some source of minerals or some part of the battery or something from another country. This is for all vehicles, not just electric vehicles or hybrids, anything like that. Any vehicle manufactured in the United States. And this applies to both personal and commuter use vehicles. Now, the impact of this one, of course, is going to encourage people to buy domestic cars. And now with this car loan interest deduction, it could save you a varied amount annually. And that depends on the loan terms. If you have a loan that has a high interest rate on it, you're paying a lot and, the interest of it up to like $10,000 a year. Yeah, that's going to make more of an effect than if you're paying, up to $1,000 or $2,000 a year in interest on the loan. So it varies. There's no real set amount for this. There's just that limit of up to $10,000 a year available through, as of now, 2028. So yeah, that's the car loan interest deduction. Let's move on to the next one here, and that's going to be the SALT deduction cap increase. SALT stands for state and local tax. You're going to see SALT often when it comes to this big, beautiful bill. State and local tax is what that is. What's changed is that there's a deduction cap increase from $10,000 a year to $40,000 a year, and this is indexed to inflation as well. Limits do apply to this. Is only available to those with an adjusted gross income under $500,000, and this reverts back to $10,000 in 2030 unless it's extended. Now, who this could benefit the most? Taxpayers in those high tax states like New York, California, New Jersey. You know, if you live in a high tax state, you know you live in a high tax state. Unless you just are totally unaware that there's states out there that have way less taxes. And also who this could benefit is especially useful for those with homeowners with high property taxes. You find yourself a homeowner in one of those states with high taxes, with those high property taxes, you need some relief probably, don't you? Now this could possibly help you out with that. So this is the SALT deduction cap increase summarized. Let's move on to the next section here, and that's going to be the self-employed and small business QBI deduction. QBI stands for qualified business income. What stayed, what's changed with this? This keeps the 20% qualified business income deduction, and it adds a $400 minimum floor for filers with $1,000 or more in QBI. So a little floor right there that adds in. Slight little change with that. Who this could benefit? It could provide a guaranteed deduction for freelancers, side hustlers, and gig workers. You don't have enough to go towards this QBI where you have that floor, the minimum of $400, so you have something at least. And now this is indexed for inflation as well, starting in 2026. Now who this could also help is that it could help lower self-employment tax burdens for those right there. Let's move on to the next section here. It's going to be about education, disability, and HSAs, health saving accounts. So with the 529 plans, these have been expanded to cover kindergarten through 12th grade tutoring, online classes, and homeschool supplies. Now the ABLE accounts have higher contribution limits that were made permanent, and this is designed for individuals with disabilities. Like I say, I'm just summarizing things right here. Also, HSAs, health savings accounts, the higher contribution limits for those continue, and the flexibility that is there for Medicare enrollees has been retained. If you are aware of that, then you are aware of that. It's one of those things like if you don't have a health saving account, then you're probably like, what are you talking about? What is this for? And that's fine. If you do have a health savings account, you might be like, okay, maybe I need to look into this a little bit more, or okay, I get it, I understand. So like I said, I want to summarize this. Don't want to make this video too long because that bill is massive. Let's get on to the next section here. That's going to be the SNAP benefits update. Here we are with some of the cuts. You see a lot of headlines going on. Definitely going to talk about it here on this video because it does affect personal finances in its own way. Now, SNAP is that supplemental nutrition program, formerly known as food stamps. What's new with this right here is that the SNAP benefit levels will now be recalculated every 3 years instead of every 5 years. And the calculation now accounts for inflation adjusted food costs and updated nutritional guidance. Also, the age range for the mandatory work requirements has increased for SNAP. Previously, it was 18 through 49 years old. Now it's from 18 years old to 54 years old. And the phase-in period is going to be going on through 2025 and 2027. Because you got to phase that in with the ages and everything to get all caught up. Of course, there's major changes with SNAP. This benefits being cut some as far as the money going into it. States now will be required to cover a larger share of SNAP costs, which could lead to reduced benefit levels or tightened eligibility depending on state budgets. So depending on if you're somebody that gets SNAP benefits, depending on where you live, things could be different from you compared to somebody else in another state who gets SNAP benefits. So it's going to be broken down into the state sum as far as some of these changes. Now, there are estimates out there that have suggested up to $300 billion in SNAP-related federal funding reductions over 10 years. So cuts definitely happening in this federal program right here. Now let's move on to another program, and that's going to be the Medicaid update. About $700 to $880 billion of Medicaid funding cuts over the next 10 years, the estimates for this. And now there's a mandatory 80 hours a month work/training requirement for adults aged 19 through 64, including many parents. So this is something to keep in mind if you're on Medicaid, can't work, you don't have a job, can't get a job or something, where they want to see, are you training towards it? Are you working towards that or something like that? So they have a mandatory 80 hours a month for that in order for you to get your Medicaid benefits. And also there's going to be more frequent eligibility checks every 6 months instead of annually. And our estimates are predicting that this could lead to millions losing coverage due to paperwork, deadlines, or income fluctuations. Now, what do I mean by that? What do people mean by that? Paperwork. There's more paperwork going on involved as far as the training and the work requirements and the eligibility checks. Income fluctuations, maybe somebody's a gig worker, their income changes every week, every 2 weeks, every month. They could jump in and out of being eligible or uneligible for Medicaid depending on their income and how it fluctuates. Some people don't understand all the paperwork. You know, there's language barriers, different things like that. So that's where people are saying millions are going to lose coverage due to the cuts in Medicaid and some of the increases of paperwork and the deadlines and with the income fluctuations. So something to keep in mind there if you're someone who gets Medicaid. Something you definitely want to probably look in further with this one big beautiful bill is what's going on with Medicaid. Like I said, this is a summary, this is condensed of all those pages, just kind of some highlights of some of the changes and updates to this. So if you're somebody who's more interested in Medicaid and SNAP from that previous slide, you may want to look more into what's changed or what's going on to keep yourself updated so you don't lose your benefits if you're someone who does and you want to keep, making sure you follow the rules and do all that to obtain those benefits. All right. And that is it with my video on the One Big Beautiful Bill Act, an overall summary, explanation, breakdown of it in relation to personal finances. Like I say, not political at all, not really opinionated. If you like the video, be sure to like it down below and subscribe to the channel if you're not already. Hope you all enjoyed the video. Take care.